On the surface, digital banking may not seem like much of a growth market for startup companies. Big traditional banks rolled out online services years ago. Today their mobile apps reside on untold millions of customers' screens, probably including yours. Yet this market is far from being locked up. Digital-only neobanks, aka challenger banks, have made waves in markets from the EU to Brazil, and the wave now building in Southeast Asia could be the tipping point that defines the future. Neobanks, by their nature, are able to combine low operating costs with superior services. Over time, that should be a winning combination. A major near-term problem is peeling customers away from existing banks that they trust and usually aren't unhappy with. In Southeast Asia, these barriers are lower, and there are conditions that actually favor new digital entrants. Here's an overview from where I sit as head of a Singapore-based VC firm. Start with target demographics. Neobanks appeal strongly to younger, Gen Y and Millennial customers. These digital natives don't typically find reassurance in having a physical branch bank nearby. Many would prefer not to visit one. And the 10-country ASEAN region, with a total population over 660 million, skews young. 8 of the countries have median ages of 30 or lower, including Indonesia, the Philippines, and Vietnam, the 3 largest, and Malaysia, one of the most prosperous. The ASEAN region also has vast numbers of currently unbanked prospects, ranging from about 30% to 80% of the adult population in various countries. Most are lower-income people, such as factory workers or farmers, but increasingly they're climbing the ladder as their nation's economies grow. And, like their more affluent neighbors, they tend to be mobile-first or mobile-only. Almost 2/3 of unbanked adults in Indonesia own mobile phones. Now let's see why neobanks can outstrip traditional banks in both onboarding and serving all of the above. How digital cost-cutting pays off. One sizable U.S. institution is PNC Bank, with operations in 19 states and about 2,400 branch offices. Imagine how much might be saved just in physical plant and personnel costs by cutting the branch count to 0. Digital newcomers can save in other areas, too. By having IT infrastructure built for today's world, they don't need to maintain legacy systems or fiddle with syncing them to newer add-ons. Figures we've studied show that neobanks have operating costs 30% to 40% lower than typical incumbents, a big chunk of which comes from streamlined back-office work. Now consider how such efficiencies translate to customer benefits. Neobanks can, and do, offer higher interest rates on savings and lower rates on loans. They can reduce or eliminate minimum balance requirements and service and transaction fees, a big draw for the unbanked, or for any budget-conscious person.